Hello, everybody. Tim Moffat here. For those of you who don't know me, I'm the Managing Director of Oakley. I'm dialing in from Adelaide, which has been suffering from an extremely cold spell, freezing myself off. I've got Akhil with me from London, which I think's been sweltering through one of its hottest summers ever.
40 degrees, would you believe?
Just
in a city that has no air conditioning.
Yuck. And Phil from Jakarta, which I assume is the same temperature today as it is every other day of the year.
Day in, day out, never below 28, never above 32, all day, all night.
Like clockwork.
Love it.
Fantastic.
They like Phil's moods, always even.
What we're going to do is a quick run through on the portfolio. We're probably going to do it a little bit different to what you're used to with other portfolio managers and fund managers. We're going to dive straight into what we think we probably could have done better over the last 6 months in a pretty difficult market. Then maybe touch on a few of the wins and just how we're seeing the world now here on out, given, getting through a pretty difficult 6 months in stock markets. You guys happy with that?
Yeah.
Yep.
Yes. I can kick it off if you like.
Yeah, go.
Apologies for might be some mall or lift music. But it should be all right. Just first up, preservation of capital is always the number one goal. First up in a year like this, we had several correct calls in sectors. We had no tech stocks. That was correct, as followers of us would know why that was the case. We had no gold stocks. We didn't think gold would go up, and we were ambivalent on that, so we didn't think there's any movement or any growth there. So that's been correct. Over April, May, June or thereabouts, we had I think almost 5 stocks that did actually enter new highs. I thought this was quite credible, really, and remarkable in a way. But the downside of that, it didn't help our outlook in one sense. Over the past 12 months, we've also had quite a number of stocks that were taken over. So I believe this shows we're on the right foot as to the stock specifics of what we've been looking at. I'd have to say too, the last 3 months has been one of, if not the most difficult investment scenarios that I've seen ever, in the sense that, the market's always difficult at times, but in the sense that we had 3 distinct and direct changes of direction in the market, one after the other, each month. Tim, you might talk a little bit about that further on, but they were exceedingly difficult to manage. We had a couple of things we could have done better. We didn't get short. Akhil might mention this a bit later. We found it very difficult to actually get short. In a way, we are limited with what the fund can do sometimes, and also the position we had with the REITs, the market didn't bear that out. In a sense, we were caught a bit short with that from a point of view of retracements, and in one sense, possibly the banks as well. Although that's a short-term procedure, we remain confident, and I'm sure the market will recognise this shortly more. Into next year, banks make higher profits when interest rates are going up. We demonstrated quite clearly, which no one else in the world seems to have picked up, that the last time the Fed raised interest rates, the last 11 times since the 1950s, 10 of those times US house prices went up. So whilst there's been a little bit of perturbance in the market, I think longer term we're looking quite good. For those who, for all the other members watching, my funds are in there too. They're down a little bit, but overall, preservation of capital is the number one item. And whilst I think the MSCI was down something like 18%, we've only been down a very small amount, so we're performed okay that way. Finally, we're well positioned. I think we're well positioned for the bounce to come. It's not going to happen tomorrow like it did in 2020, but But as the market sorts itself out, all the big funds and stuff, they'll have to buy. They'll have to keep buying. We're well placed to expand. We've had a very decent cash position over the last few months. It's harder than I thought to actually go fully into cash. It's just not that doable in a way, from a fund point of view. But we're well placed now to continue to keep buying. Much better place than most others, I would imagine. It gives us a chance, as we thought, to be buying in with practically almost 1/3 of our fund into better placed positions at better prices, which we'll be doing over the coming month or two as we see things turn up. That's me.
Yeah, the short position was a bit of a disappointment. We obviously got very close talking about it a number of times. Probably was a bit confused in April because the portfolio was actually looking pretty firm. That would have been ideally the ideal time, but the Aussie market was sort of testing into new highs, whereas the US market wasn't quite looking as strong. Anyway, there's no point. There's also a lot of positives to take away. You mentioned the takeovers we've had, and obviously the high cash levels. So investors will be able to see we've been picking and chipping away at a few holdings and adding to things here and there. A few new names popping up in the portfolio. So I expect that's going to continue over the next few months. Like you said, Phil, I don't think the market's going to rip away like it did in March 2020. Might churn around for a while, but that should help us identify what's going to move first and where we want to be. Probably the other thing, if you want to talk about sectors and where that was hurt, is the banks, the banking cycle. I mean, the interest rate dynamic. Really, rates probably should have been going up for 12 or 18 months slowly, and we've really had this aggressive rate rise. Those rate rises have been compressed into a very, very short period of time, and that was, that in Australia really started in April, and all of a sudden the banks came under enormous pressure. I mean, Commonwealth Bank fell, I think it was nearly 20%. I think in the long term,
perhaps, but we did during that down, we did add a bank, so I think that's all right.
Yeah, we're pretty comfortable with the banks that we own. If you go through them, the ones that we have owned have held up better than the others. So it's really just a matter of now. I think if we look forward over a 2 to 4 year time frame, so the prices that we've just seen in a few of the banks, and probably the REITs as well, will look reasonably attractive, and probably looking back will be a good entry point. Did you want to have any comments on that, Akhil?
Nothing in particular, other than the fact that you're right. The Fed has been far too late. I think we actually said this to some of our subscribers last year, that the central banks are always behind the curve, and this is one of the consequences of that is that they sort of in a sense they panic. There's been a fair amount to panic about this year, it has to be said. I mean, this has been a difficult year for a lot of different reasons. Including the prospect of nuclear war in Europe, which of course would, if anything is going to turn sentiment negative, that it would be that sort of thing, and the effects of inflation and other things on economies and therefore on interest rates. So there's been that sort of panic. I think people have forgotten over the last couple of years that markets can go down, I think if you look back at real estate and banking stocks over a 4 year period in the second half of the cycle, it will show pretty strong growth. I'm pretty confident to say when we look back in 2025, 2026, but there are years where it's difficult. And an example of that from the US, which was the chart I looked at earlier this week, Toll Brothers, a large US house builder. It's been hit quite hard this year. So it's down about 40%. But actually, interestingly, at pretty much exactly the same point last cycle, it was hit by 40% as well. So these things do happen. But it's what happens next, which is, I think, the key point.
Yeah, fantastic. All right, I think we wanted to keep it short and sweet. We're going to try and do these a little bit more often, quarterly, just to give a little bit of a colour on what's been happening in the portfolio. And so unless there's anything else to add, we might wrap it up there and do it again shortly.
Yeah, that's good.
Brilliant.
Fantastic. Thanks, guys.
Thank you.